Silver hit $76 per ounce today, December 27, 2025, after breaking $70 just 4 days ago, an ascent that has vaporized over $30 billion from 5 major U.S. banks' balance sheets in real time. These institutions, holding short positions on 708 million ounces, are trapped as each dollar rise inflicts $78 million in collective damage. And the price isn't pausing, it's accelerating. COMEX registered inventory, the metal actually available for delivery, has plummeted to 150 million ounces from 346 million in 2020, while open interest claims 750 million ounces in paper contracts, a 5-to-1 mismatch that's already triggered a 47.6 million ounce drain in December's first 4 days, over 60% of what's left. This isn't volatility, it's the physical market exposing the paper illusion, and the vaults are emptying now, forcing banks to buy back at levels they engineered to suppress. Shanghai inventories sit at 446 tons, the lowest since 2016, signaling a global fracture where promises outpace atoms. I watch these signals converge, and the logic is inescapable. The system that pinned silver below $33 in October 2024, allowing banks to accumulate shorts worth $1.3 billion underwater then, has now reversed into a squeeze they can't unwind without catastrophic admissions. These banks sold metal they never held, betting on perpetual control through derivatives and futures, mechanisms that inflated paper supply while physical stocks eroded. But December 2025 marks the pivot. Industrial users, not speculators, are standing for delivery, pulling 200 million ounces for solar panels alone in 2024, plus 90 million for electric vehicles, all amid a 282 million ounce global deficit for the 4th straight year. This demand is embedded in production lines, solar conductivity paste, EV motor contacts, AI data center thermal management, structural needs that regulators can't erase like they did in 1980 with the Hunt brothers. Back then, the Hunts amassed 200 million ounces through speculation, spiking silver from $6 to $50 before COMEX altered rules mid-game, imposing position limits that liquidated their holdings and crashed the price. It protected the banks, ruined the speculators, and restored the facade of stability. But observe the inversion now. No lone actors cornering the market. Instead, fragmented industrial buyers worldwide are draining vaults because the metal is consumed irreversibly, eaten by tech and energy transitions that governments mandate. The Biden and Trump administrations both push solar deployments for 100 million homes by 2030, each panel demanding about 1/3 ounce, tallying hundreds of millions more ounces that mining can't supply. Silver output ties 75 to 80% to byproduct from copper, zinc, and lead. Inelastic, unresponsive to price alone, unless base metals justify expansion. Here's where the fracture deepens. 4 years of deficits have stripped above-ground stocks, leaving COMEX and London vaults stressed, Shanghai scrambling, and no quick refill. Consider the bank's behavior as the clearest indictment. For decades, U.S. banks maintained net short positions in silver. Every CFTC report since 2014 confirmed it, a constant like gravitational pull. Then, in December 2025's Bank Participation Report, they flipped net long for the first time in history. 22 banks overall remain net short, 42,311 contracts. But the U.S. cohort's reversal screams capitulation. They see vault movements in real time, calculate exposures, and choose to cover, likely including J.P. Morgan, fined $920 million in 2020 for spoofing precious metals from 2008 to 2016. During that manipulation, they placed thousands of fake orders to depress prices, yet accumulated 600 million to 1 billion physical ounces at suppressed levels. Now, flipping long at $76, they've engineered a wealth transfer. Buy low via rigging, exit shorts, ride the ascent. The fine, pocket change against billions in gains. This isn't conspiracy, it's observed pattern. Suppress with paper, hoard the real, then switch when the break arrives. If you've tracked bank reports or traded metals yourself, how does this flip align with what you're seeing on the ground? Share your take in the comments, because these shifts often precede wider cracks. The system's loss of control manifests in premiums. On Christmas Day 2025, Chinese markets went parabolic, with Shanghai contracts entering backwardation, spot prices exceeding futures, a scream of immediate scarcity where traders pay extra for now, over later. Normal contango accounts for storage. Backwardation exposes acute shortages. China, consuming over 50% of global industrial silver and controlling 70% of refining, isn't exporting. It's importing from Western vaults for domestic use, bifurcating prices. A China premium for physical control, scraps for the rest. Geopolitically, this vulnerability's defense. U.S. missiles need silver for guidance, radar, electronics. Contractors hedge with COMEX futures, but if delivery fails and cash settles instead, production halts. China holds the atoms, we trade promises. This dependency, outsourced to unreliable chains, threatens military readiness amid escalating tensions. Layer in the derivatives web. U.S. banks hold $8 trillion in notional exposures across categories, per the Office of the Comptroller of the Currency. Precious metals are fractional, but concentrated shorts among 5 players create systemic risk. Echoing 2008's mortgage derivatives, where losses cascaded via margin calls and counterparty doubts, silver's $30 billion bleed could force liquidations elsewhere, spreading contagion. The Bank for International Settlements notes growing precious metals derivatives concentration. When vaults empty, those positions unwind violently. COMEX's 150,000 open contracts versus 150 million deliverable ounces? A bank-run analogy, 5 claims per dollar leads to failure when even 20% demand payout, vault zeroed. December 60% drain in 4 days. Project's exhaustion in weeks if velocity holds. Industrial demand accelerates this. 665 million ounces for tech in 2024. Projected 10 to 15% growth in 2025 per Silver Institute. Overwhelming 835 million ounce mine output. History mirrors but distorts here. The 1980 squeeze collapsed under rule changes because speculation drove it. Regulators could intervene without halting real economy. Now, structural consumption defies that. You can't legislate away silver's role in 5G, water purification, medical devices. The World Gold Council tracks surging physical investment alongside amplifying pressure. If you're in solar or EV supply chains, what shortages are you already navigating? Detail it in the comments, as these ground-level signals complete the picture. Projections expose the math. At $82 to $85 by quarter 126, per analysts like Andrew Maguire, COMEX mechanisms fail utterly, pushing bank losses past $35 billion, triggering downgrades. This matches inflation-adjusted 1980 peak percentage-wise, but grounded in deficits, not bets. BNP Paribas targets $100 by year-end 2026. Long forecast sees 93 to 80 early. At these levels, solar manufacturers face triple costs, budgeted 30 silver, now $85. Eroding margins, hiking prices, or pausing output, derailing energy goals. Push further. $150 to $170 by 2027, equaling true inflation-adjusted 1980 high. If COMEX declares force majeure, cash settling, while physical premiums soar, dealers demand $150 plus for bars. ETFs and futures holders get paper value. Physical owners reap transfer. We've seen premiums, 60% over spot in 2020 COVID disruptions, climbing now. China's example foreshadows global bifurcation. Key dates amplify. January 20th, 2026. CFTC Chair, Rostin Behnam exits. Successor faces potential interventions. Limits, halts, settlements, to shield banks, as in 1980. Early February's January delivery, with record open interest, could drain remnants if December's pace repeats. March-April. Fed rate cuts to 2.5% narrow opportunity costs for non-yielding silver, drawing institutional inflows. 1% global assets shift overwhelms supply. The fractional reserve core unravels. Paper markets promise liquidity via cash settlements, but when industrials insist on metal, the vault's emptiness forces default. It's not insolvency, but illiquidity. Assets exist, but not accessible. Confidence shattered in December. Backwardation, bank flips, parabolic China, 60% drain. If you analyze derivatives or follow CFTC data, interpret this confidence break for us in the comments. What other markets might it bleed into? The real economy bears the fracture. No silver stalls solar for 100 million homes, rations EVs, delays 5G, halts defense builds. Governments bet trillions on green transitions dependent on this atom. Scarcity halts them cold. Geopolitics sharpens. China's hoard starves Western chains, leveraging strategic control over what was once monetary, now industrial essential. Observe the silence. Financial media calls it volatility. Regulators mute, yet signals scream. The Silver Institute's 4-year deficit data, unchanged, drains stocks critically. If you're monitoring global inventories or trade flows, how do these deficits manifest in your region? Write it out in the comments to map the spread. This interweave, market control lost to physical pull, industrial halts rippling to geopolitics, reveals the break. Earlier, paper dominance worked because settlement sufficed. Now, Consumption permanence exposes the ratio's lie. Banks' capitulation isn't salvation. It's admission of entrapment. Losses cascading as they buy into the vertical. Deeper, the inelastic supply locks the trap. Byproduct status means no silver surge without base metal booms. Yet copper-zinc economics lag. 2025's projected 1.2 billion ounce demand versus 835 million supply widens the 282 million deficit, accelerating if EV solar ramps. At 10% delivery demands, 75 million ounces claimed halves COMEX vault, 20% zeros it. Velocity from December's 4-day 47.6 million ounce pull suggests weeks to empty. Here's the logic break. Systems assume minimal physical pulls, like banks presume few withdrawals, but runs expose. If you've witnessed commodity runs or bank stresses, compare this to past events in the comments. The parallels might reveal escalation paths. The outcome crystallizes. COMEX cash settles, decoupling paper from physical. Premiums tripling overnight as in 2020, but scaled. Window for physical acquisition narrows daily. Vaults drain, users lock supply. For finance, $30 billion losses probe deeper exposures, echoing 2008 contagion via opacity. Silver as canary, small, but revealing derivatives fragility. Economy-wide, green agendas stall without paste, contacts, management. Trillions wasted if scarcity bites. Geopolitically, U.S. vulnerability to China's control, defense compromised. This phase, paper breaking, physical asserting, unfolds without reversal, physics dictating over finance. The era of managed suppression ended December 2025. What follows is recalibration to scarcity's reality, control slipping irretrievably. If this systemic view resonates or clashes with your observations, lay out your interpretation in the comments. We're piecing the fracture together. Silver crossed $77.80 per ounce in early trading on December 28, 2025, less than 24 hours after the $76 print. And the velocity feels exponential, not parabolic in the classic sense, but the kind of acceleration that occurs when momentum no longer needs external fuel because the system itself is disintegrating under its own contradictions. The 5 major U.S. banks are no longer merely bleeding. Their aggregate mark-to-market losses on silver shorts have likely exceeded $32 billion in the last 48 hours alone. Assuming the same $78 million per dollar sensitivity holds at these levels, that number is not static. It compounds hourly as open interest refuses to collapse and physical standing for delivery requests continue to cluster. COMEX futures are still trading, still settling in cash for most participants, but the registered inventory, now reportedly below 140 million ounces after weekend adjustments and fresh delivery notices, cannot mathematically support even a modest 15 to 18% of open contracts if they all pivot to physical. The mismatch is no longer theoretical, it is operational. What separates this fracture from every prior precious metals dislocation is the absence of a single lever that can be pulled to restore equilibrium. In 1980, the COMEX board could rewrite margin rules overnight because the pressure came from 2 brothers and their leveraged vehicles. Today, the pressure is diffuse, industrial, and geographically fragmented. Chinese state-backed manufacturers pulling bars for photovoltaic paste, European battery producers securing contacts for next-generation EV drivetrains, American defense, subcontractors quietly increasing standing orders for radar-grade silver alloys. None of these actors can be margin called into submission. They do not trade on leverage, they consume. And consumption does not negotiate with futures curves. Shanghai silver futures closed at an effective spot equivalent of roughly 82 to 84 equivalent in local terms yesterday, when adjusted for currency and logistics. Yet London and New York benchmarks still hover in the high 70s. That $6 to $8 premium is not arbitrage opportunity, it is rationing signal. Refiners in China are paying it because domestic industrial quotas leave no room for delay, and they are sourcing the differential by drawing directly on LME and COMEX warrants rather than waiting for new mine output. The London Bullion Market Association reported a further 12-ton withdrawal from its eligible vaults last week. Small in absolute terms until you realize that total LME silver stocks sit at historic multi-decade lows. The global above-ground hoard that once buffered these dislocations has been eaten. 4 consecutive years of 250 to 280 million ounce deficits have done what no speculator ever could. They have turned inventory from buffer into bottleneck. Look at the CFTC's most recent bank participation report again. Not the headline net figures, but the composition shift beneath them. U.S. commercial banks flipped net long in silver futures and options combined for the first time since at least 2000. The series goes back further, but granular bank-level data starts there. This is not a tactical repositioning by one desk. It is coordinated risk reduction across institutions that share custody of the same vaults and clearing relationships. When JP Morgan, HSBC, Citigroup, Bank of America, and Goldman Sachs, all historically structural shorts, move in the same direction simultaneously, the message is not bullish speculation. It is defensive evacuation. They are buying back paper exposure because they have already secured the physical side of the equation, either through direct accumulation during the suppression years or through long-term offtake agreements that never appear in public reporting. The paper game was profitable only while the physical remained invisible and abundant. Now the physical is visible and scarce, so the paper must be closed before delivery defaults become public legal filings. If you have access to real-time vault reporting, LBMA warrant lists, or internal COMEX delivery notices, what velocity of withdrawals are you seeing this weekend into Monday? Drop the numbers or the trend in the comments, because the official aggregates always lag the actual movement. The mathematics of the squeeze have entered a phase where every incremental price increase feeds the next one through forced covering, rather than new fundamental buying. Each dollar higher adds another $78 million in pain to the concentrated short cohort. At $80, the collective loss crosses $35 billion. At $85, it nears $40 billion. Levels that begin to threaten Tier 1 capital ratios at the most exposed institutions, even after collateral haircuts. Regulators do not need to publish stress test results for silver. The banks are self-administering the test in real time, and the margin clerks are not sleeping. Meanwhile, industrial consumption projections for 2026 are being quietly revised upward. The Silver Institute's preliminary 2025 demand estimate already sits at 1.21 billion ounces against 840 million ounces of supply, a 370 million ounce gap when recycling is included at realistic recovery rates. Solar photovoltaic demand alone is tracking toward 220 to 240 million ounces next year as China accelerates installations to offset export restrictions on finished panels, and the United States pushes domestic content under IRA subsidies. Electric vehicles, despite macroeconomic headwinds, still require 95 to 110 million ounces annually because silver remains irreplaceable in high current switching and conductive interfaces. Add 5G base station upgrades, AI accelerator cooling systems, and next-generation fighter jet radar arrays, and the structural floor keeps rising. Unlike oil or copper, silver cannot be substituted at scale without performance penalties that current designs will not accept. This is the point where earlier historical analogies fail completely. The 1980 intervention worked because the system could still pretend the commodity was monetary first and industrial second. Regulators changed rules, speculators were liquidated, physical demand normalized, and price collapsed back into the paper envelope. Today, silver is industrial first, by a widening margin, and monetary only as a secondary attribute. You cannot force major a solar factory into using aluminum paste without catastrophic efficiency losses. You cannot rewrite physics so that EV charging ports function without silver contacts. The demand is not elastic to price in the short to medium term. It is locked. That locks the supply response too, because primary silver mines are price takers from copper and zinc economics. Even at $100 spot, primary silver production rises only marginally, perhaps 3 to 5% over 5 years, unless lead zinc copper prices justify opening new polymetallic deposits. Those prices are not following silver higher because base metal demand faces its own headwinds from construction slowdowns and electrification saturation curves. If you're positioned in base metals, mining finance, or project development, does higher silver change your CapEx allocation models at all? Or is it still treated as a free bonus credit? Write what you're seeing because that inelasticity is the hidden multiplier here. The fracture widens when you overlay monetary policy. The Federal Reserve's projected path still includes 75 to 100 basis points of cuts through mid-2026. Real yields on treasuries falling towards 0.5 to 1% remove the opportunity cost penalty for holding non-yielding physical metal. Pension funds and sovereign wealth vehicles that ignored silver at 1 to 2% allocations during the high-rate regime now face internal pressure to hedge currency debasement and supply chain fragility. A 0.5% global institutional reallocation equals roughly 120 to 150 million ounces of new demand, enough to absorb an entire year's mine production before it reaches industrial users. That is not speculation. That is portfolio mathematics meeting physical scarcity. January delivery on COMEX opens in less than 3 weeks. Open interest for the January contract, normally a quiet roll period, sits at levels usually reserved for March or July. If December's 47.6 million ounce claim volume repeats, or even halves, the registered pile disappears before the first week of February. At that moment, the exchange faces a binary choice. declare force majeure, and cash settle everything above a certain threshold, or allow selective defaults that trigger cross-default clauses across clearing members. Either path fractures trust in the entire precious metals complex. Cash settlement at COMEX prices, while physical trades 30 to 60% higher, creates a two-tier market overnight. Paper holders receive dollars. Physical holders receive metal that can no longer be purchased at paper prices. The wealth transfer is not gradual. It is instantaneous and permanent. China's backwardation has already previewed the split. Local premiums are not closing because arbitrage cannot function when export licenses are restricted and domestic quotas are mandatory. The rest of the world is left bidding for scraps. For U.S. defense primes and Tier 1 suppliers, this is no longer an abstract risk. A missile guidance system that requires 0.8 ounces of high-purity silver per unit cannot be built if the allocated COMEX delivery is replaced with a cash check. The contractor then competes in the open physical market against Chinese industrial buyers who pay premiums without hesitation. Strategic stockpiles exist, but they are finite and replenishment is slow. The vulnerability is structural, and it is exposed now. If you work in defense electronics, aerospace supply chain management, or government procurement, how are you modeling silver availability for 2026 to 2028 contracts? Share the contingency planning you're seeing, because that is where the national security dimension becomes concrete. The system is not collapsing in a single dramatic event. It is failing in layers. First, the paper price decouples from physical availability. Then, industrial users lock long-term supply at escalating premiums. Then banks liquidate correlated positions to meet margin, transmitting pressure into equities, credit, and currencies. Finally, regulators intervene, not to save retail, but to firewall the banking system from cascading counterparty failures. The sequence is already underway. The speed depends on how aggressively physical demand continues to stand for delivery in the next 4 weeks. Silver at $77.80 today is not a new high. It is confirmation that yesterday's high was not an outlier. The vaults continue to drain. The shorts continue to cover. The industrial buyers continue to consume. And the regulators remain silent. An absence that is louder than any statement. This is the phase where control is lost, not through malice, but through arithmetic. Paper promises outnumber atoms by 5 to 1, then 10 to 1 in some derivative tranches. When the ratio becomes unsustainable, the system does not negotiate. It breaks. And once broken, it does not reassemble in the old shape. The question left is not whether the fracture widens, but how far the shock propagates before new equilibria form around physical reality instead of financial engineering. Physics has begun to dictate terms. Finance is only now beginning to listen.